Welcome all to the Node. I am Mike, aka Veteran Crypto, and this is your place for news, interviews, and crypto and DeFi and TradFi education. So, with that, we're going to dive right into this, and I'm going to introduce our official website really quick, just because there is a ton of free value here. We'd love to point this out. We're very proud of it. If you come to the node.pro, you can access the Intel library. So this is all of the deep dives that we have done on this show in the past month or two since we started doing these deep dives. We do about 13 of these each week, and we're working our way through all the major projects. And what we're focusing on is what we call the trifecta. So the grades that we give in here does not mean you cannot make money off of these. It simply means that, based off of our criteria, our three criteria, that that is the grade that we give it. And the criteria is currently, not its potential, but currently, what fees and revenue does it generate? What level of adoption is there? And those two things are pretty correlated. The more adoption and the more TVL and the more transactions that are occurring on a chain or a protocol, the more fees and revenue that are going to be generated. And so that is a huge part of any business, be it crypto or brick and mortar or whatever. That's how businesses are evaluated. And then third, and this is specific to crypto, is value capture. So the token that is part of that ecosystem, how does it have a mechanism that allows you, the token holder, to directly profit from the products and services of that project? Because if it doesn't, I cannot stress this enough. You are holding a meme coin. You are buying the equivalent of a football jersey for your favorite crypto project. You're giving them free liquidity to bootstrap their project, and you can't be surprised if they're not making revenue and they're dumping the token on you to to fund operations, to pay themselves, to keep the lights on, to pay developers, whatever. If they're not generating fees and revenue, the only two ways that they can make money is either from investors or from dumping the token. And that traditionally has been most of crypto, is they dump the token, to try to get their project going. And it's a race. Can we get, to a place to where we have products and services that we can sell and make fees and revenue, or are we going to have to dump the token? And major projects still do this. Ripple being one of them. Ripple has 1 billion tokens that unlock from escrow each month, and a lot of the times they relock it, but a lot of the times they sell it. But this is true of a lot of projects. So just because we give a D grade or a C grade to one of these projects does not mean that it's not a good project necessarily. It just means that as it currently sits, judged off those three criteria, that's how we view it. So David, how's it going, brother? Oh, can't hear you. Your microphone is... Hey, what up, Crypto Steve-O?
There we go. How about that?
Yes, we're good.
Yeah. No, I was just convening with the ghost of Mitch McConnell. And he told me that his communist wife...
Dude, he has a stroke, and instead of being by his side, she jumps on a plane to China.
Come on, guy. That's just not a good look.
What the... I've never liked Mitch McConnell. He is literally the Republican version of Nancy Pelosi. He is everything.
I think he's more like that guy. What was the Fang thing? What was his name again?
Mitch McConnell has some really good stock picks as well. He's made quite the fortune being a public servant. He's very similar to Nancy Pelosi.
Like, but at least Nancy Pelosi isn't married to a communist spy. Although, isn't her husband like in big doo-doo, like as of recently for something? Regardless.
Well, he's the one that's been, that is the genius investor that somehow, outperforms every other, and he's the one that got hit with a hammer by the gay homeless dude.
Right. Yeah. What is a gay homeless dude with a hammer doing in your bedroom? Like, what?
No. But anyway, so let's jump into some new. Actually, you know what? Let's add you here so when we come back, and I'm going to actually play some clips. So right off the bat, let's listen to this, and then we'll kind of get some commentary.
Oh, I like him.
Why does he really look like banks come in and try to kill their competition at the expense of the American consumer, right? People in America should be able to earn more money on their money. I think stablecoins are an opportunity for banks. They should be able to build great product lines with this. It's an opportunity for crypto companies. Congress and the laws that get passed, they should really create a level playing field and say, this is allowed, this is not allowed. Now, all American companies, go compete, try to build the best products and services. That's great. What's not great is if the banks can put their thumb on the scale to try to kill some of their competition, and they only pay about, 14 basis points on the average savings account. Consumers should be able to earn 3.8% on their stablecoin rewards. And so we're going to keep fighting for our customers' rights and the 52 million Americans who use crypto every day.
I mean, what would you say to the argument that banks?
So this is something, and there's even some people in crypto that have been bashing, Brian Armstrong. And, and I'm not saying I'm a huge fan of his or anything, but everything that he's saying about this, and everything he's fighting for. And yeah, of course he has, a biased opinion. They're a crypto, centralized exchange, and they're trying to make sure that the products and services that they offer are they have the ability to offer yield producing assets and things like that. But I'm more aligned with what he's fighting for. I believe that we should be able to earn yield off of our assets. Why is it that we're forced to put our money in the bank where they earn yield and we don't get shit? I think it's healthy competition. What do you think, David?
So I think that unfortunately we still have politicians like the late Mitch McConnell in Congress. I think that's really the core of this problem, because if there were people in Congress who represented us, then you wouldn't have to have the head of the largest American centralized exchange going out there and saying, hey, we could offer you a product that'll pay you 3.5%, but we're legally not allowed to.
Yeah.
Like, who made that law? Well, it was the banks.
Debate. Well, it shouldn't even be a debate.
It shouldn't.
As long as it's sustainable, as long as which, I mean, we've kind of shown it is on good stables that, earning a couple of percent on, stables, because banks do it already. Banks makes massive money for every dollar that we put in it. What is it, like up to 40 times they can loan that dollar out? And each of those times they're charging like 7% interest. So, I mean, that's a massive amount of yield that at least part of should be going to us. It's our money.
I agree with you 100%. And so those net interest margins that these banks have been able to earn on top of whatever the treasury rate is, they've been doing pretty darn well with that. But why can't everyday Americans earn yield on their checking account? Like I do, but why can't everyone else? The only reason I do is because I live in crypto. But I feel like, I believe wholeheartedly that everyone should have the ability to earn at least 3.5%. I mean, inflation is well above 3.5%, regardless of whatever the government says. So, like, just to get closer to breaking even, you've got to be earning 3.5% on your, whatever is in your checking account balance. Like, that's just a no-brainer. And, what he's saying here is we could offer you, America, this product, but because the banks write the legislation, it's been made illegal. You can't have it. And the crazy thing about it too, Mike, is, these banks, this is a whole new space for them. If they wanted to just jump in and innovate, they've got the bankroll to be able to build something amazing. And so I think that OUSD, whatever that OUSD is, I mean, look, let's be completely frank and honest. I do kind of think that USDC and of course this OUSD, I think that they're CBDCs in disguise. I think that they're going to be regulated into becoming CBDCs if they haven't already. So, if you're going to hold a CBDC coin, then you've at least got to earn, 3.5% on it. So I'm all for what Brian Armstrong is saying here, and I don't understand why people have given him so much heat. I don't get it. One day he's loved, and one day people are talking poorly about what he's doing in the halls of Congress as you see him here, and it just doesn't make any sense to me, man. I think that we should be able to earn yield legally on our stablecoin balances, and unfortunately, that's been made illegal by that Genius Act. And so, that's why I'm not too bullish on clarity. I think clarity it's going to be more like give all the innovators clarity on which foreign country to move to so they can build act. That's what I think it's going to be, because if all of a sudden, you've got $1 million of compliance before you can even launch your financial product, whatever your DApp is that you want to build, if you've got to all of a sudden, pony up $1 million for attorneys and fees and whatever regulations you need to satisfy, compliance stuff you need to satisfy before you can even launch your product. Well, the brilliant guy with a laptop and an internet connection sitting in a cafe is going to say, hey, you know what? I can build my amazing financial product. I just can't do it in the United States. So I'm going to hop on a plane and I'm going to go to Singapore. And that's what's going to happen.
Yeah. That's why there's a bunch of crypto projects that are in Switzerland.
Yeah.
Is because of that. They're going to a place that they know is free, and they're going to be able to develop their product and not have to worry about the kind of volatile legislative the regulation. It's like they can go there, they can build, and however the cards fall, wherever in the world as far as regulation, they can launch their product there, in to whatever degree. Because if you're in the U.S. and you're building here, then your total product is needs to be compliant with the U.S. But if you're in Switzerland, then you can develop your product however you see fit, and then if it has product market fit, then in the EU or in the US or in Southeast Asia or whatever, then you can launch it there. And so you can. It's just a better way to do business. And unfortunately, because of what I feel is corruption in our government, where you have people like Elizabeth Warren that obviously work for the banks. She does not work for the people. I mean, look at the fortune that she's amassed in just a couple of terms.
Right.
In Washington, she makes like $274,000 a year, and somehow she has what is it now, like 8-digit net worth, like $40 million or something like that.
She's I think she's 60 or something, approaching 9 figures. That type of like enriching yourself as a politician, that's really grimy. There's a lot of guys and gals who were wealthy before they became politicians, but to become a politician, like AOC, for example, bartender from somewhere in New York, and
her credit was so bad she was complaining because nobody would even rent her an apartment in DC.
And then you got the Ilhan Omars of the world, but it's not just on the left, it's just mostly on the left. But what infuriates me so much, Mike, is that it's on the right too. It's like, oh, come on, guys. What are you doing? What else you got? Oh, this guy, isn't his name Cuomo? Wasn't he the one responsible for locking down grandmas during the pandemic and killing them?
Here, what in your view what is the main hurdle that's preventing this legislation from actually making it across the line?
Yeah, it's new, it's different, it raises issues. You're talking about a restructuring of the traditional finance system. And traditional finance players are some of the most powerful people in the country, right? And they want to make sure that the system is protected.
Oh, shit. he's OKX joint venture co-chair. Isn't that like an exchange?
Yes. So I think OKX is a really big APAC exchange, like that region. I'm not entirely positive. In fact, I'll look that up right this second just to find out. But OKX is a tier 1 exchange, really big exchange. Where is OKX located in the world? What region? Big exchange. So ICE Intercontinental Exchange. I think ICE owns a bunch of the exchanges in New York and Chicago. I think Futures. Don't recall exactly who they own, but ICE, I think, owns a lot of the exchanges here in the United States. And I think that ICE was out of London originally. Not positive there either, but OKX, let's see here. OKX Exchange. OKX Exchange is what I'm looking for. But yeah, so this guy Cuomo, he's got a really sordid history. But what he's saying here is true.
With his politics and all that, I want to stick to crypto today.
Sure. So what he's saying here is very true. That the entrenched interests in finance have a lot of sway in the legislation that's going to get passed. And that's exactly what we were saying. I was just saying that if it were not for banksters lobbying Congress, that we would probably have legislation that benefits us. And that's exactly, I think, what he just said. What do you think, Mike?
It's the same thing as pharmaceutical companies, in the medical industrial complex, or the corrections, like prisons and stuff like that. It's anything that where they have a bunch of money, they basically tell the politicians, this is what you're going to say in the legislation, and they're yes sir, they freaking and because they want to keep making money.
Yes, master. We make laws for you, master.
Exactly.
Yeah.
And so that's all they do is they draft legislation that benefits the rich and powerful, and that hurts us, the people. I mean, look at what's going on with taxes. Look at what's going on with inflation. Look at what's going on. Not our wages, aren't going up at the same rate. So basically, we're making less and less, and they're taking more and more. So it's people need to wake up. We need to take our government back, because crypto, honestly, is what I see as kind of the last, our last chance to get ahead of all this. There's a lot of people living off credit cards right now. And, there's a lot of people that are hurting in a really bad way, financially, and, student loans and, all that kind of stuff too. Trying to buy a house, good luck. It's, if we don't wake up and we don't take our country back, and start voting, these people out of office, and voting for people that want to have term limits, it's going to get worse. But here, let's continue this.
So you have powerful concerns on both sides. You don't have the most cooperative Congress and Senate that I have seen, and I've worked with many, and that is an understatement when I say they're not the most cooperative group that we've had. You do have a partisan divide. I am hopeful, and I'm hopeful because the U.S. is getting pushed. You look at what Europe has just done with ESMA and MICA, and it's good for the industry. It's good for the consumer, because for this financial ecosystem to work, you need two elements. One, you need the product. A company like OKX, Star Shoes, been at it for 13 years. He has the product.
I love how he's shilling OKX.
Hold on. Let's let the guy finish, and then we'll pause it. We'll count.
Trust comes from government regulation. All these people who say, government regulation is the problem. No, it's not. Government regulation helps the private industry because it provides trust. People want to know they were protected. I was the housing secretary. People wanted to know
I go ahead, David. I kept cutting you off. I wanted to hear what he had to say.
My goodness.
That's where he was going with it, and I want to touch on that. So go ahead.
Yeah. So he's saying there that what's going on in Europe with Micah is a good thing. Well, I have clients all over the world, Mike, private, high net worth individuals, and everyone from multimillionaires to stay-at-home moms who just want to build a crypto DeFi skill set. Like, I've worked with hundreds of people and continue to. And so I was talking to a guy, first thing this morning out of Australia, and he's telling me that he can't on-ramp because his banks have blocked him. And the reason why they blocked him is they want to basically pull back the curtain on his entire life so that he can buy crypto. And he can't buy more than 500 Australian dollars of any fiat, any stablecoin asset without having some onerous KYC AML check done. And even after he applied for that KYC AML, he got declined and his bank account got frozen. So
what the fuck?
So that's APAC, but that's what Micah is too. Micah is in Europe. So, the Europeans, man, are really, really getting screwed with that legislation. Oh, and this guy, do you remember what Vlad Tenev did during the GameStop debacle?
Yeah.
Where he got a phone call from Mr. I don't recall his name, over at Citadel. And all of a sudden the buy button gets turned off on Robinhood's app. Yeah. Man. So I just, whenever I see him, I'm instantly reminded of that.
Exactly. So yeah, let's play this and then we'll give a little bit of commentary.
I believe that the future of crypto is in real world assets. If an asset is not tied to underlying utility, if it's not a productive asset, what's the benefit of making another million different meme coins? There's an evolution where crypto is becoming infrastructure that powers financial markets and in particular real world assets. So tokenized stocks, you'll have tokenized futures, tokenized privates, which is an area that we're also very deep into.
Tokenized privates
running on
I know. It's like tokenized privates that we're deep into. Okay.
Traditional rails will eventually become on-chain tokenized. I think increasingly crypto and traditional finance will merge, and not to say that, Bitcoin is going to become less important or meaningful, but I think what drives crypto growth will be real assets with fundamental utility utilizing crypto technology.
Man. So he just said, so there's the juxtaposition. Did you see that, Mike? Where he said, I'm not saying that Bitcoin won't grow, but these real assets over here with real utility, unlike Bitcoin. Bitcoin, I don't know about Bitcoin. It's a fugazi. But these real things over here with all this regulation where you can't buy $500 of them without them checking on the inside of your butthole. What's going on here, man?
Well, I see his point and I see your point. When it comes to, being self-sovereign, yes, that really is the only Bitcoin utility that I really see, because really the only reason that Bitcoin has value is because it's perceived to have value. It's people
that's true, but that's what the history of money is. Money exactly. has been so many different things. Yeah.
100%. But as we've seen in history, we've seen, different currencies basically go to zero. We've seen, the Venezuelan peso. We saw, the ruble, freaking dumped, a while back when they got sanctions put on them. Was that Zimbabwe dollar? Not that it was worth much to begin with, but, they had to come up with $1 trillion bill or something like that, and people were still using it as toilet paper. They were, basically filing, silver and gold and stuff like that, to make payments if they could get hold of U.S. dollars. So, yes, it's true of all things. But in a way, I agree with him where, the same way that we came up with the trifecta, where, this is what makes something valuable is adoption. Bitcoin has adoption, fees and revenue. doesn't really have fees and revenue, but you're buying it hoping that somebody will buy it from you for more than you bought it for. You're hoping it goes up in value. And then value capture. We can debate, if it has value capture, but it has some fundamental issues that I know that you agree with.
It does. It does,
Yeah.
unfortunately. According to our trifecta, Bitcoin has some problems. Absolutely, it does. However,
even
they
with the
do.
miners, talk about incentivizing miners. There is a very real risk that and that's what secures the network. And if they don't start figuring out a way to do what was it you called them? It's the smart contracts on Bitcoin.
Covenants.
If they don't come up with a way for Bitcoin mainnet to start generating some fees and revenue to help incentivize these miners, I mean, we've already seen a lot of these big mining companies, Bitcoin mining companies, have started jumping ship and using their processing power for AI because it's more profitable. So that makes Bitcoin less secure. So it's something that we need to be aware of. And I'm not saying sell your Bitcoin, and this isn't meant to FUD Bitcoin, but you have to understand the fundamentals.
Right. You've at least got to go in eyes open. You've just got to know about this stuff. You've got to know that there are problems with the Bitcoin miners' business model. You've just got to know that. It's a fact. You've got to know that there's no smart contract layer on the Bitcoin layer 1. There are these layer 2s that create these quasi environments for smart contracts, but they don't settle on the layer 1. So there isn't a lot of transaction volume on the layer 1 generated by these layer 2 networks like Lightning, for example. They're off chain by definition. So you just got to know these things. It's not about fudding Bitcoin. I love Bitcoin. I love me some Bitcoin. It is I think the only freedom money. But it needs an upgrade. I'll put it that way.
Our chat is having quite an interesting conversation. They're talking about, and it is a good theory. It says no hype. It says I kind of feel like the banks are going to try and have a set few crypto, kind of like that USDO, then pass a law that screws the rest of the industry. I think that's why it's so important that that we support a lot of these decentralized exchanges, and basically decouple ourselves, from big banks, start on ramping your liquidity, responsibly and safely, as possible into DeFi, so that you can earn yield, so that you can spend your money how you want. I would say so that you can, don't get your money frozen. But shit, we saw USDT and USDC getting frozen during the the whole Aave debacle. So it's getting really, really hard to be truly self-sovereign in crypto. It seems like as a lot of this stuff evolves, there's a lot of kind of shady stuff. All the CBDC fears that we had. And we were worried about new stable coins. All the while, the old faithfuls became those for the most part.
Yeah. And then what is this OUSD that I keep seeing? All these different institutions have come together to use OUSD. I want to learn more about that. That could be worth a deep dive.
Yeah, let's. I'll make a note of that for tomorrow. I know
because
it's a bunch of things got together and made their own stable coin, basically.
Right. But it was like a lot of banks. It wasn't just like, JP Morgan Chase and Goldman Sachs said, we're going to launch a coin. It was like, I saw a list of 50 different institutions. So I don't know what that means for Circle or for Tether, but it's definitely something I want to learn about.
Well, and I'll be curious, because a lot of them are using like Canton Network, and Canton is price wise has not been doing good the past day or two. We, like I said, we like to be fully transparent here. It's down to about 12.5 cents right now.
Right. So, what I see for CC is, 10.6 cents is solid support. And just, keep in mind that this is a new chain, but it's also where it seems to me as though all of these big banks are migrating their largest books of business, treasury repos onto Canton. But it's not just that. We're seeing tokenized equities also. And we're going to see, the DApp layer from Ethereum and Solana will be able to be essentially ported onto Canton private subnets if developers want to through Zenith, right? So I just see a phenomenal opportunity there. But right now, super inflationary, like super inflationary right now. So, 12.6 cents for Canton. I don't hold any CC as of right now. I have no position, but this is right now. It's number 4 on my watch list, on my shopping list. CC.
If it dips below 10 cents, I might even put a buy order in case it wicks down. If it dips below 10 cents, I'll probably buy a couple $100 more.
Yeah, so I just think to myself, like, how do we model where the price could go given the BME gets above 1.0? If the burn mint gets above 1.0, how could we model like where the token price could go based on that? So the way that I think about it is for every CC token that is emitted, once you get above that 1.0 threshold, that means that more CC tokens are burned than are, I guess, minted. So for every incremental dollar of transaction volume that burns more CC tokens, what does that do to the price? So what is the impact on price?
I don't know if there's enough data yet, but I think that we're going to have a lot more data on the impact of that here in 5 days. So on the 13th, in 5 days. On the 13th, the soft launch, and they're talking about it in the chat. It's the DTCC they've selected Stellar and Canton to so far. Anybody can run on their project there that the DTCC is doing. There's over like 50 that are on their committee or their not board but their working group. But they're doing a soft launch on Canton on the 13th. And if all goes well, they're doing a full launch in October of this year. So whenever we see, the kind of the TVL or the, amount of fees, or transactions and the fees being generated, and we see its effect on the price, either positively, negatively, whatever, potentially we could extrapolate from that what it could do, as it closer to that, that one, factor where, that burn mint equilibrium gets flipped to Canton becoming deflationary instead of inflationary like it is currently.
You see what Crypto Steve's saying in the chat about Bitcoin being digital gold and not digital currency. So, Crypto Steve, I agree and I also disagree. So I view Bitcoin, if it had a smart contract layer, if it had covenants, I think that Bitcoin could become kind of like a global reserve treasury asset that is permissionless and non-sovereign. And so those two things together, reserve treasury asset, but permissionless and non-sovereign reserve treasury asset, I think that makes Bitcoin something where you could see finance priced in Satoshis rather than in US dollars. So I really do view Bitcoin as like a parallel financial system, potentially. Ethereum also has the potential to become that too. I don't think Solana does. It seems too centralized right now. They would need to change. They would need to make some changes. Ethereum is also centralized too when you compare it to Bitcoin. So I guess you might say that maybe Monero could become some type of reserve treasury asset also, simply because of how decentralized it really is. But and so when Steve, you say Bitcoin is just way too slow to be used as a currency. Well, you see, here's the thing though. Lightning, that's just an example, layer 2 network on top of Bitcoin. Lightning is extremely fast. And so there are definitely opportunities to make Bitcoin into a treasury asset and then also use it as a currency if you want to. But you don't need to. You don't need to spend Bitcoin. What you need is transaction volume. There needs to be transaction volume on the layer 1. But with Taproot, you can essentially mint stablecoins on the Bitcoin layer 1. And those stablecoins could be, US dollar denominated. They could be Japanese yen denominated. You name it. Doesn't matter. Anything. You can mint anything you want using Taproot. So you could use Bitcoin as your unit of account, but you could spend dollars on the Bitcoin layer 1. Just need covenants. And so, we get that future. That's freedom right there. That's true freedom right there. So can't be censored. That's the whole thing.
Yeah.
Yeah. What else we got going on in the news?
So it looks like in institutional DeFi, Binance launches BTC Yield, bringing covered call Bitcoin income strategy to users. It looks like Binance introduced BTC Yield product, allowing long-term holders to generate income via a covered call strategy, mirroring moves in traditional finance. Are we?
Not a bad idea. Not a bad idea. So it's actually a decent strategy to run, with Bitcoin near the lows. So here's the thing though. How much of the upside could you potentially miss out on if Bitcoin rips? If there's another big print event, as a result of God knows what, could it be some problem with the AI trade? All of this, what looks to be over investment in data centers and, stuff like this. Could that blow up? Who knows what the next crisis is going to be? But the next time there's a big print of dollars, that could be the catalyst that just pushes Bitcoin to the moon. I mean, look, it would not surprise me, Mike, if at some point in the future, some of these top digital assets like Bitcoin, Ethereum, really just thinking about those two, but there could be some point in the future where they have massive green days. I think that it could be possible that Bitcoin could see a plus $100,000 candle day, a plus 100K session. And you know what? I think that could even be possible for Ethereum too. Maybe not 100K, but like a really, really big section of the upside. Right. Yeah. And so the only reason would be, not because all of a sudden Bitcoin or Ethereum is so much better as a product. It's because of the denominator, the dollar. So that unit of account, if there's some big print event and the dollar, inflates rapidly, well, people are going to seek safety in digital assets. And Bitcoin and Ethereum, I think, could perform extremely well. But the problem for Binance or people who engage in this covered call strategy from that big move to the upside is when you're running a covered call, your upside's capped. Like the stock, the underlying gets called away from you if price pushes too high. So you run this strategy in a market. This is a bullish strategy. Don't get me wrong, but you're capping your upside. So you do it for a little bit of protection on the downside, not a whole lot, but a little bit, and some yield generation. So what type of yield are they talking about here? Is it 2%, 5%? What type of yield?
Let's see if they even get into that. I didn't see any numbers that flashed, but it says it's for both retail and institutional users by the major crypto exchange. Bitcoin does not have a native staking mechanism, creating demand for ways for long-term holders to seek income from their BTC. Agreed. This launch also reflects broader demand for Bitcoin income strategies in traditional finance. Covered call approaches are well established in institutional markets, and products such as the NEOS Bitcoin High Income ETF and BlackRock's iShares Bitcoin Premium Income ETF have attracted significant assets. Goldman Sachs has also filed to launch a Bitcoin yield product. underscoring continued demand for Bitcoin income strategies. By bringing this strategy to a streamlined crypto native format, Binance is making it easier for users to access a familiar income approach within a single platform as it continues to expand beyond trading into a broader financial super app. Let's see if we can find.
So, I mean, those are all positive developments, you know, and BNB is definitely on my shopping list. So they're
the token.
Yeah. You know, so look, I dislike the idea of a Chinese exchange that manipulates digital asset markets. I don't like that. And, you know, how many times have we seen big dumps where you look at Wintermute and it's like, oh, there we go. That's where the supply is coming from. I don't like that. I don't like that it seems as though Binance has been in some form or fashion, you know, involved in a lot of these suspicious events. You know, I dislike that. However, I like money. So, you know, like, I think that BNB has a little bit of that flywheel going on. And Aster, I'm pretty sure the research that I performed, Aster feeds BNB, I believe. And since Aster is kind of like, you know, it looks like it could be a way for Binance to generate greater trading volumes. I got to think that BNB will likely continue to perform well. Although, what has been the impact of them losing access to the European market? You know, because I know that Binance didn't get a MiCA license. So on July 1st of this month, the first of this month, you know, they lost access to the European market. I don't know what that meant for their business, how much business they lost, but it went directly to Coinbase and their competitors.
So Steve-O, we actually did a deep dive on the BNB token yesterday, if you want to check that out. But it's one of the tokens that's made it onto my watch list. So my watch list as it sits right now is BNB, Tron, Hype, Canton, Near, Tau, Uniswap, Jupe, Arrow, and Pendle. That's my and you know, of course, Bitcoin and you know potentially Ethereum. But you know, as far as altcoins, these are my picks right now, and it's because of them meeting the trifecta. And a lot of these, if you look, you know, off of their all-time highs. I actually built my watch list on CoinMarketCap because I'm able to you know put a lot of these you know kind of measuring sticks. But I'm able to look at the mind share. So like right now, BNB is up 72%, 73% on its mind share. Uniswap is up like 73%. And then off of their all-time highs, BNB is only down 60%. Tron is only down 25%. Hype is only down 12%. You know, Canton is only down 35%. You know, it's you know some of these other ones are are down a lot more. But I mean, it's you know we've shown here on the show that a lot of these you know as far as you know relative to the Bitcoin price, they're outperforming Bitcoin. You know, Hype is one of those, BNB is one of those, Canton is one of those. You know, a lot of these are outperforming Bitcoin. You know, and definitely outperforming other alts. So, you know, I'm the more that we're using this measuring, you know, the trifecta as like a measuring stick, the more I'm seeing it as, you know, nothing's going to be perfect, but it seems like it is like a divining rod pointing us at the right projects.
I agree. And, you know, so my watch list, Mike, is Bitcoin, ETH, Sol, BNB, Canton, Tron, Hype, and Tau. And I just threw Tau in there because I want to speculate on this AI game, you know, AI inference, whatever's going on BitTensor Tau. To be completely honest, man, you know, I don't keep track of all the different goings on and subnets on BitTensor Tau as closely as I probably should. But it seems like they're constantly making moves over there with those subnets. And I want to speculate that something good is going to come of it. So it made it onto my watch list, my shopping list today. Bitcoin, ETH, Sol, BNB, Canton, Tron, Hype, Tau. That's what I'm looking at. And, you know, funnily enough, I think that one of the assets on that shopping list does not really satisfy our trifecta. And it's
Which
the one that I'm going to hold the most of is Bitcoin. So, like, it's just so funny. Like, what? But
all right, let's see what else we got here. Corporate DeFi Dev Corp announces strategic leadership transition of Disclaimer Coin. NASDAQ listed DFDV is shifting leadership of its meme coin project Zero Stack Holdings to focus on ecosystem growth and utility. Never heard of it.
What a horrible name for a coin or something. Zero Stack?
Yeah.
Zero Stack Holdings? Like, as in, what happened to your stack? Well,
yeah,
it went to zero.
Let's see what else we got. Virtune AB announces.
I'm going to grab some more coffee, Mike. I'll be right back.
All right. Virtune Hyperliquid ETP, a new physically backed hype ETP, has begun trading on NASDAQ in Stockholm and Helsinki. Let's take a look at that. That sounds kind of interesting. So let's skip over to Nya. So Virtune is a Swedish asset manager and issuer of physically backed crypto exchange traded products, or ETPs. Since its launch in 2023, Virtune has earned the trust of more than 160,000 investors and today manages approximately 250 million in assets under management, reinforcing its position as one of Europe's leading issuers of regulated crypto ETPs. The company also holds over 90% market share for crypto ETNs on NASDAQ Nordics. Virtune is now expanding its product offering with a listing of the Virtune Hyperliquid ETP. This dual listing marks another step in their mission to provide Nordic investors with secure, transparent, and regulated exposure to the digital asset market. Hyperliquid has emerged as one of the most compelling products in digital assets. This is a quote from Christopher Koch, demonstrating how demand is shifting towards decentralized, always-on financial markets. As the crypto market matures, tokenomics are becoming an increasingly important consideration for investors. This is what we are screaming from the rooftops here.
Every day. This is all we talk about every day.
He's explaining value capture. For these tokens, if your token does not have value capture, why are you investing in it? I mean, you can get speculative pumps, absolutely. You can trade volatility, absolutely. But if you are investing long term and your token does not have value capture, in my opinion, you are making a huge mistake. My 2 cents.
I agree with you. That's why we talk about this every day. Yeah. It's got to satisfy that trifecta. So
exactly. So it says here, Hyperliquid's buyback mechanism, and that's what we're talking about value capture. It is programmatic buybacks and burns. That is what I feel is making the hype token up and to the right, while the rest of the market has gone down and to the right.
And Mike, I think that Hyperliquid, like the hype token, it could be over the next year one of, if not the best performer on the board of the large caps, of the big caps.
Looking at the chart,
dude, we get a breakout above like $80, and that thing enters firmly into price discovery mode. My speculation, and you heard it here first, is that it goes to $350 next year. That's my speculation.
All right. We are, let's see. It's a physically backed exchange traded product designed to offer investors a secure and cost-effective way to gain exposure to hype. This is made possible through a transparent and physically backed infrastructure or structure with institutional grade security. So the key information. So it's 100% physically backed by hype. 0.95% annual management fee, so 1% basically. First day of trading is the 7th of July. I guess it doesn't really matter to anybody unless you're in that jurisdiction, I guess. But it goes to show you that these institutions are getting into getting into digital assets. And you can see it here, on rwa.xyz. Canton over the past 30 days, it's up 8% as far as TVL. Providence, it's up about 5.5%. XRP up 5%. ZK Sync, 0.73%. But you need to look at these, and again, you need to see if the token has value capture.
So you see what Crypto Steves is saying in the chat. It's a valid point. We're not going to butcher you for liking Pump Fund. Pump Fund is one of the best protocols on Solana because it makes a ton of money. But did we ever run deep dive research on Pump Fund? Because I'm looking at the chart.
We'll do OUSD and Pump Fund tomorrow.
Dude, those are they couldn't be more similar and yet also diametrically opposed. You've got like the meme coin layer on the meme coin casino of Solana, and then you've got the fiat, Fugazi meme coin of OUSD.
The bankers meme.
Right. But the thing for me, though, Crypto Stevo, is I'm looking at the chart of Pump. And, look, I stare at charts all day. So I've seen, I follow like the top 500 cryptos. And this pattern that I see tells me massive dilution, no value capture, just by looking at the chart. So I know that Pump Fund makes a ton of money. I think they make like $7 million a week right now in the depths of the bear market. But it looks as though there is no mechanism by which those revenues return to Pump token holders. And if you're saying that there's a huge token unlock coming up next week, in my mind, that would be a reason to sell short, not back up the truck and get long. So curious to see, what your thoughts are on that. You're saying that a lot of money goes to holders as well. So, that's exactly what we need to verify. And that's what we're going to do tomorrow. So,
no. And you're right, Steve-O. And that's true of Hype as well. The flywheel works great, right now for Hype because it's generating so many fees, but that flywheel can work in reverse. If it gets to a point to where there isn't the volumes, there isn't the fees being generated for that programmatic buyback and burn, it can flip inflationary. And if it flips inflationary, if history is so far as any judge of how it's affected the price to the upside, it potentially could affect it in the same way to the downside. The same thing with Canton. Right now it's inflationary. We haven't seen a whole lot of price appreciation on Canton, even though there's a lot of bullish things going on with it. That's the same thing with the flywheel on Arrow. Arrow has it's down right now, but the flywheel that they're so proud of, not the new one. I don't even know if they use a flywheel on the new protocol. We haven't seen all the details yet, but in the existing model, the flywheel that they're so proud of, it is beneficial as long as the right, dominoes are in play. But if, it can work in reverse and it can work against, token holders as well. So it's just important that you understand. And that's the only reason we're here. We're not here to try to get you to buy or sell anything. We're here to just give you the facts, educate you on these tokens, on these assets, on the mechanics, on the fundamentals of these projects. And you do your own research on top of that and do whatever you want. It's your money. It's your liquidity. Your risk profile. I couldn't care less how you invest your
Mike, you see what Crypto Steve said in the chat? Per DeFi Llama, the two coins that are, number one and number two in holder revenue is Hype and Pump. Can you bring up DeFi Llama? Can we take a look at that? That's interesting to me because I'm looking at the chart of Pump and it's done nothing but go down and down and to the right. And yet, if there's some legitimate mechanism by which revenues accrue to token holders, that would be a big positive. So I wonder why the token hasn't performed. I'm curious about that. Okay. Let's see here. And Mike, what you were saying about, we don't have an incentive. We don't have it's referred to as a perverse incentive. So many other crypto influencers may have potentially, we need evidence before we can say for sure, but it seems as though the incentive mechanism is broken there. So when many people talk about certain projects, it could be simply because they get a lot of views, and so that would be an incentive for them to speak positively about a particular project, and that influences their large follower group, to go out and take action on that project. We don't have any financial incentive for any project, any coin, none, no protocols, no coins, no nothing. The node network is cash flow negative. Okay, we don't get paid to do this. I do this because I like talking to you every day, Mike, and I love learning about this stuff, and I love everyone in the chat, and I love our community, man. This is a hell of a lot of fun. That's why I do this. I'm building a programmatic trading app, an algorithmic trading app. I'm focused on the node network, DeFi University, and the trading app. That's how I make money. But not from the channel. We don't have any financial arrangements with any coins, any tokens, any chains, any projects, any protocols, no DEXs, no centralized exchanges, none of that. And so what that means is we can tell you what we think, and we just present evidence. That's all we do. So it's about, being educated for the strategery. It's about education. Exactly. That's all it's about. You got to go in eyes open. So what do you see here with Pump?
So, Steve-O said, click on fees and revenue. So it looks like holders revenue, there's a metric here, and it looks like it must have gotten churned on around July of last year. And it's this green, and it looks like through some mechanism, maybe they do incentivize people that hold the Pump token.
So I guess it could be, and I'm sure we'll find out more tomorrow, but it could be that the token's going down and to the right, even though it seems like there's some value capture mechanism. Maybe it's just not great enough. Maybe that it's still too inflationary. Mike, if you hop on back on over to CoinMarketCap and you take a look at Pump on CoinMarketCap, we'd be able to see the FDV and the float. So I'm just curious how much is left to unlock, what the float is. So let's see, Pump Fund. Let's see what's going on with the FDV. 1.5 B, 1.5 billion market cap of
1.48, but yeah, 1.5.
And what's the current market cap?
The current market cap is 601 million.
Okay, and the total supply?
The total supply is right now 851 billion, with a max supply of 1 trillion.
Oh, okay. So what's this circulating supply?
Circulating supply is 402 billion. So
gotcha.
About 40% of the max supply.
Okay. So we would need to dig into the token unlock schedule and learn more about, whatever that unlock schedule looks like, because it seems as though it's got...
Right here, July 12th, Pump unlocks 82.5 billion tokens.
Wow. So 80 billion tokens, that's, basically, what is that? So we're talking about 20% of the current circulating supply unlocking on July 12th.
And it's held by investors and the team. So the unlock is 82.5 billion Pump, around 8.25% of the 1 trillion max supply, and a large portion of today's circulating supply.
20% of today's circulating supply. Yeah. That's big.
So unlock size and structure, market impact and risks. Pump's current market cap is around $610 million US, with 24-hour volume around 70 million USD. So the unlocked value is a meaningful fraction of both market cap and typical daily trading activity. If a significant share of these tokens is sold on the open market, it could create a short-term selling pressure, wider spreads, and more volatile price action, especially around the unlock date. Might be an opportunity for a short. The key risk is how concentrated these allocations are and whether private sale investors and team members have internal lockups. stage sale plans, or OTC agreements that reduce direct exchange selling. If most holders treat the unlock as an opportunity to realize gains quickly, pressure could extend beyond the unlock day. Yeah.
So, I would just say, and I see what you're saying in the chat, Crypto Steve-O, about, price plummeting and thinking about buying. I would always caution against that because, look, these digital assets are.
I would agree on this project.
Well, yeah, but just in general, the idea that if something is on offer, meaning if something's cheap, if it's on sale, if it's down significantly from a high, that does not make it a good buy. We're not talking about buying toilet paper at the grocery store. If it's 50% off, if it's on offer, maybe you buy more toilet paper or something. That's not what these digital assets are. So if something is on sale, if it's down significantly from a recent high, that doesn't make it a good buy. You don't want to be DCAing down. You don't want to pyramid down. You don't want to compound losses on the way down. You want to avoid doing that.
One thing I do want to point out, Steve-O, is the way that we're evaluating these projects are very similar to the way traditional businesses are evaluated when it comes to stocks and things like that. And looking at a lot of these projects, and just because it's the first, always the first one we run into as far as market cap, but it's a perfect example is XRP. If you look at the market cap, it is, what the hell happened to market cap?
So that's volume. You're looking at volume right there.
I know. That's what
it's the one on the very far right, that column on the very far right, fully diluted.
Well, that's the fully diluted, but yeah, that'll work. $108 billion.
Oh, ouch.
Based on what?
Whole lot of nada.
What fees and revenue? There's no way that Ripple, and that's if the XRP token even had any kind of value capture, which it doesn't, other than, being a cheap gas token. I actually did the math on XRP. It was over 10,000 years to burn 10% at max, max transactions per second, TPS. It would take over 10,000 years at max TPS, 24/7, 365, with the price of gas to burn through 10% of the token. That is really the only value capture that XRP has. There are some instances to where it's potentially beneficial for it to be used as a bridge asset, but with ROUSD, a lot of the use cases, for it as a vehicle to move value was taken away, and we really haven't seen a whole lot of adoption. So, this is kind of what I'm getting at is, $108 billion valuation, basically based off what, even Solana, I'm not saying Solana's a bad project, but almost $50 billion valuation. Hyperliquid, $64 billion. Doge.
That's the FDV. That's the FDV. Yeah. So I think the market cap for Hype could get to that current FDV. But you see what Crypto Steve-O said in the chat there about liking to buy something dirt cheap if he likes the underlying fundamentals? Well, think about this. How do you define what dirt cheap is? So let's say that unlock for pump comes on the 12th, and price. Yeah, let's just say that unlock for pump comes on the 12th, and price dumps. Right? Let's say the price is down 20%, just for the sake of this hypothetical example. Well, how do you know that that's the low? How do you know that that is actually dirt cheap? What if you buy when it's down 20% and then it continues to be down a further 50% from there? And then you buy again when it's down a further 50% because, hey, it must be an even better bargain, right? It was down 20%, now it's down an additional 50%. You would think, oh, it's even more on sale. It's even more on offer. Well, yeah, but what if it's down a further 50% from there? And so what you end up doing by DCAing down is compounding losses on the way down. I like to buy high and sell higher, or sell low and buy back lower, rather than compounding losses on the way down. So I just think that it's really dangerous to think about digital assets or any investment as, if it's cheap, it must be a good bargain.
He is bringing up a valid point. So looking at the market cap, it only has a $601 million market cap, and it's making about $1 billion a year in fees. And if the token has value capture, potentially, it could, meme coins are a huge part of crypto. People fucking love them. It could be something to keep an eye on. I'm not going to buy it, but it could be something to keep an eye on.
Definitely keep an eye on it, for sure. But the fact that there are so many metrics that look good for it, and yet token prices are nothing but go straight down, that tells me that there's something really, really broken with those tokenomics there, at least now.
I think if things, once things flip bullish and we start getting into where people, get into the meme coin casino again, and things like that, we could see it, flip the other direction. So,
and you see what he said here, Mike? This is great. So patience, waiting, rather than trying to time a bottom. Because look, I don't know about you, Crypto Steve-O, but my crystal ball is in the shop. I need to call up, my Mr. Wizard and say, hey, I need my crystal ball back. I don't know the future. It's impossible for anyone to be able to predict the future. And so what that means is I can't tell when the bottom is in until the chart and the asset tells me that the bottom is in. So being patient, waiting for a trend change might be a more prudent strategy, rather than saying, hey, I know something and I know this is the bottom, because really no one knows anything. Anything can happen in these markets. All of a sudden meme coins could be made functionally illegal in the United States by the Clarity Act. Who knows? There's so many different things that could play out. But yeah, Jeff, just call Miss Cleo. She'll tell you.
Dude, I remember Miss Cleo. That's a throwback. Jeff. All right. Yeah. So this is, let's, we're going to get into the deep dives. We're a little bit over news time here, but I'm enjoying this conversation. But here's a perfect example, a project that I'm bullish on, but, we need to be realistic. It has a $5 billion market cap, Canton. But it generates $2 million currently, roughly $2 million in fees per day. That's $60 million per month and $720 million per year. So, that is actually, because isn't valuations like annual revenue times 5 or something like that?
So you're talking about a multiple on earnings. Yeah. There are a bunch of different metrics. You could, assign a multiple to revenues. You could assign a multiple to profits. You could assign a multiple to sales. These are TradFi.
I'm just going off like Shark Tank and like my dealings with VCs and stuff like that. Usually, it's the money that a company makes times 5 is kind of what I've always been doing.
So it depends on the niche. Depends on what niche or what vertical that business is in. That's going to determine the multiple that people are comfortable assigning to cash flows of some type. But those are
using that. Canton is actually aligned with, if that's, if you use what I just, mentioned, it's actually aligned. It's one of the few that I've found that, because Canton is the highest earning, project in crypto, because it makes $2 million a day. And at one point it was making $3 million.
I think that USDT and USDC might actually generate more revenue, but by law, not fees, right? But by law, those revenues cannot return to token holders, which is what we were saying at the beginning of the show. Because that really sucks for token holders.
Well, but they're stable coins, not a chain. But right, I know what you're getting at, though.
Yeah.
as far as investing in these projects, hoping for price appreciation. You can invest in stables if you want to see if the price goes up. But,
yeah, good luck with that.
but Canton is the highest earning chain out there, and it looks like it's somewhat aligned. Again, if you look at XRP, I don't know how much, if any, that they're making as far as fees, but I know it's nowhere near enough to support a $67.7 billion market cap.
Exactly right. Exactly right.
And I don't just want to pick on XRP. I mean, it's pretty much every project out there.
I mean, you can literally just take a dart and throw it at your screen, and whichever project it lands on, it's likely to show you really, really poor value capture, really poor tokenomics. There are very few projects that actually have excellent tokenomics, very few, and even fewer that actually make money. So, yeah. All right, you want to hop into these deep dives?
Yeah, go ahead and share your screen. But while you do that, here, let's do this. So Steve-O, you mentioned this on X this morning, and I went and looked, and the TVL isn't getting crushed. Like I said, it's up like 8% over the past 30 days.
It depends where you look. It depends where you look. There are some accounts on X that have been posting about TVL, going way down. It depends on how you count it, I think.
And I would be interested to find some places where it's reflecting what Steve was talking about, because we got to again here at this channel, we're real. I mean, I'm bullish on Canton, but if there's a bunch of TVL that's getting sucked off of sucked off the chain, I definitely want to take a look at that and maybe get to the bottom of why. And go ahead and start the deep dive. I'm gonna do some searching.
Okay, let's start off here with Polkadot. This is like the OG substrate chain. I believe it's referred to as substrate. And so I just want to take a look at USDT real quick, just to see, what has this done in terms of price performance in US dollar terms. And so this is what the chart looks like. I've got it pulled up here on a weekly. And so this is DOT. These are Binance data. So DOT is trading not only below its bear market lows from last bear market, but it's also trading below its bear market lows from 2 bear markets ago. So this is one of the poorest performers. This is not what you would call performant. This is anti-performant. So this tells me that there's significant problems with this chain just by taking a look at the performance of the token here. So let's go ahead and jump into the deep dive, and let's learn a little bit about Polkadot.
On March 14th, 2026, the Polkadot network executed the Pi Day upgrade, moving away from its original economic design to a precise mathematical grid. Before this date, the network minted roughly 120 million new DOT tokens every year. This annual inflation of approximately 7.5 to 10% continuously diluted passive token holders, as validators regularly liquidated newly minted rewards to cover their hardware operating costs. When the community approved Referendum 1710, inflation dropped straight from 10% to 3.11%, hitting an absolute hard cap of 2.1 billion tokens. Simultaneously, the annual minted supply shrank by 53.6%, dropping to roughly 55 million units. Imposing this structural scarcity was a strict engineering prerequisite to support 3 incoming architectural overhauls. First, the protocol replaced its mechanism of burning transaction fees with active capital recycling through the dynamic allocation pool. Second, it transitioned network block space from fixed slot auctions into a commercial commodity market called Agile Core Time. Third, it initiated...
I just want to pause it there for a second. Is DOT on the SEC's Sweet 16 list? Is it one of the officially recognized digital commodities or not? I don't recall.
The retirement of the central relay chain to deploy the JAM supercomputer. To understand how these systems operate together, we need to map the flow of capital and computation from the bottom up. For a decentralized Layer 0 network, the monetary policy acts as the base engineering layer required to power and secure all higher-level computational architecture. The new issuance schedule relies on a specific mathematical framework to ensure and
It is.
Yeah.
Okay.
manage the remaining token supply. Every 2 years, the network applies a stepped decay function tied directly to the mathematical constant pi. This formula calculates issuance across 2-year epochs. Z is the fixed 2.1 billion hard ceiling. The 13.14% decrease applies only to the remaining unminted reserve. As circulating supply grows, issuance shrinks exponentially, approaching that ceiling. This table compares terminal supply projections for 2040.
2040. Oh my goodness. What year is it? 2026.
Left column shows the legacy model's unlimited cap, growing past 3.4 billion tokens. On the right, the capped model shows a restricted 1.91 billion tokens, eliminating nearly 1.5 billion from future circulation. By following this trajectory, emissions will mathematically cease entirely down to the smallest atomic unit, 1 Planck, around the year 2160. Establishing a mathematically verifiable, finite supply provides the predictability necessary for validators to commit capital and secure the network over the long term. With new token minting strictly capped, the protocol had to develop a more efficient way to route existing capital. Initially, the community debated RSC 0010, which proposed burning network revenues. Instead, they opted for active capital preservation. They built the Dynamic Allocation Pool, or DApp, a permanent on-chain reservoir that replaces all legacy treasury and fee burn mechanisms. 4 pipelines fund the central DApp reservoir: new issuance, transaction fees, core time revenues, and validator slashes. The reservoir splits into 3 outflows: 45.2% to staker rewards, 22.6% to validator incentives, and 32.2% to a strategic reserve. Under Phase 2 of this rollout, validator economics shift heavily. Operators now receive emissions tied to a 1-year vesting schedule, plus a fixed infrastructure payment of roughly $2,000 in stablecoins to offset hardware costs. However, the protocol mandates a minimum self-stake of 10,000 tokens for validators. This creates friction for commercial node operators, who manage infrastructure for institutional clients, but lack the capital to meet the requirement themselves. This logic diagram outlines the solution: the staking operator proxy. The institutional staker node retains total ownership of the capital, while passing restricted, operational-only session keys via a proxy link to the operator node, effectively removing custodial liability. But enforcing these strict capital rules still carries significant systemic risks, as demonstrated during the June 2026 staking election stall. Geographic latency issues, particularly after the activation of elastic scaling, caused operators in Latin America, Oceania, and Africa to experience higher rates of missed votes. The election algorithm enforced physical parameter floors that were disconnected from changes in active nominator backing. This disadvantaged remote operators and actively threatened the network's geographic decentralization. Programmatic capital routing is highly efficient, yet when rigid capital thresholds clash with the physical latency of global hardware, it can trigger severe consensus-level failures. Moving beyond capital routing, the network also restructured how builders acquire commercial computational capacity. Under the legacy crowd loan system, developers had to lock up massive capital reserves for 2 years just to secure a slot lease. The protocol replaced this with Agile Core Time, a 2-tiered, market-driven allocation layer managed directly by the Core Time chain. On the left are legacy 2-year locked blocks. On the right, bulk Core Time represents fluid 28-day NFT regions bought via a descending auction.
So I just want to pause it here for a second, Mike. I'm having a difficult time understanding from the 5 minutes and 40 seconds that we've watched this video what DOT actually does. Like, what is this for?
What your definition of is
right? Like, well, what does this do again? Like, does this make money in any way, shape, or form? So it's explaining these complex protocol, mechanics, but What is it? What's the do?
Nick says this is definitely Ellie narrating this.
Right? I don't see the doo-doo, or I don't see the there. It looks like doo-doo. There is no there.
Yeah.
So, yeah.
Below that, on-demand core time provides instantaneous spot bidding scheduling credits, bypassing block lockups entirely. By purchasing exactly the compute they need when they need it, developers no longer face upfront capital barriers to entry. All revenue generated from these block space sales flows directly back into the dynamic allocation pool. Agile core time moved block space from a static, illiquid asset into a commodity market that perpetually finances network security. The absolute supply cap, DAP, and agile core time served as infrastructural preparations for the final architectural layer, the join accumulate machine, or JAM. To deploy JAM, the network initiated the retirement of its central relay chain. This network topology diagram illustrates how JAM merges an Ethereum-style global singleton object environment with Polkadot's parallelized multi-core execution. Instead of relying on opinionated parachains, JAM utilizes permissionless, modular computational services that operate through a two-stage transactionless processing pipeline. The 2026 protocol overhaul required 3 distinct architectural layers to reach this point. The stack begins with the base layer, a 2.1 billion cap establishing supply constraints. The middle layer routes capital, capturing core time revenues for security. The top layer locks in, the JAM supercomputer executing subsystems powered by the layers below.
Okay, this JAM supercomputer executing subsystems powered by the layer below. To do what? Like that's what I'm missing here. What is the there?
Pay no attention to that. Okay, Chewbacca was a Wookiee from Endor.
Chewbacca. It costs about $350.
The survival and scale of the Polkadot 3.0 supercomputer relies on this balance between mathematical caps and dynamic on-chain resource allocation.
Dude, so what does it do again? Okay, executive summary.
It does stuff and things. Well,
at the place with the guy.
I found a little bit of alpha here. So this is somebody I've been following. Giannis. Price of CC started moving aggressively. So I went to check to the downside. So I went to check whether it's broad selling or something specific, and found this. Circle's own validator wallet never sent CC anywhere until June 26th, then moved 40 million CC tokens to Fireblocks in 2 bursts, overlapping with the 2 sharpest drops on the chart. Fireblocks hosts market makers and trading desks, so this pattern is consistent with selling.
Maybe.
I can't confirm the downstream destination, but a wallet that had never moved before doing this twice at these exact moments is worth looking into.
Yes, it is.
So he actually cited his source. So this is Circle's validator at Lighthouse. The total CC that they have, 85,825,000. And you can go down and you can look and see, the amount that was moved and when, and all of that. So he cited his source. So that's important to important to point out. So anyway, that is interesting. That if that's true, I didn't dive that deep, but if the 2 dips that we've seen on Canton's price aligns perfectly with the 2 movements of Circle's Canton token, because Circle runs a validator, sending it to Fireblocks in 2 bursts, that could be a huge selling pressure. So just something something to point out.
Yeah. So selling for what, I wonder? And we don't know that it's actually being sold. It could just be custody. But
exactly.
Yeah, if there's a really tight correlation in time between the movement of those tokens to Fireblocks and the price going down, that can be important to watch. But it doesn't necessarily imply that there's a causal relationship Like the movement of those tokens to Fireblocks could not be the cause. It might not be the cause of number go down, but if there's yeah.
So
Oh, I see the DeFi TVL. Yep.
You don't want to be using DeFi Llama to be watching Canton's TVL. That we've actually covered this. When they don't include a lot of things when it comes. So like right here, they're only including the TVL on whatever this pool party is. It's only measuring what it has in like on DeFi protocols. It's basically these three dexes. So there's a dex that has $250,000 of TVL, and that's the only thing that it's measuring on Canton. If you go to rwa.xyz, it shows the repo, the Broadbridge repo TVL.
And that's what we're so bullish on.
And that is what's generating the $2 million worth of fees. That is pretty much the only thing that's burning Canton right now. And again, we're going to be fully transparent. Here in 5 days, we're potentially going to be getting more fees burned from the DTCC doing the soft launch. But the $360 billion minus the $250,000, then that is the TVL that's on Canton. So I hope that helps. Yeah,
and it's through Broadridge, right? That's the institution. Yeah. So here we go back to that information about Polkadot. Mike, as you were running through that, I was taking a look over here on DeFi Llama for more information about Polkadot. Like, what is the there? Like, what is it? What does it do? What does the do? And I couldn't. What does the do? I couldn't find much on DeFi Llama. Has anyone ever used Polkadot for anything? Like, have you ever used Polkadot for anything? Never. So it looks like you got a couple of bridges here, I guess. But I've never used this for anything. I don't know anyone that's ever used this for anything. But I guess you could use it to like bridge Tau. Because Tau is a substrate type chain, I think. But yeah,
really quick, Steve-O, if this is a valid question that you bring up, why is Canton only represented RWA, not distributed? If you hover over on rwa.xyz, hover over distributed, basically distributed, the way that I interpret this is retail. So RWA tokens using the blockchain as a distribution layer, enabling on-chain investors to subscribe, hold, and manage assets directly through their own wallets or custodians. So this I am, attributing to, and that's why Ethereum is the largest on that, and Canton isn't even on the radar here. But if you go to represented, RWA tokens using the blockchain as a record-keeping layer, enhancing transparency, reconciliation, and operational efficiency without enabling on-chain investor transfer or distribution. So this is institutions. Right. So that's how I am, choosing to understand this. And so, because Canton really isn't made for retail. There are some things that are launching.
Not yet.
But with Zenith, they are launching here soon. We did an interview with them. You might want to check out Steve-O. They are actually bringing EVM compatible dApps to the Canton network. So, that's going to start generating potentially a lot of fees and stuff as well, and be a bridge for retail to start utilizing the Canton network potentially.
Right. So I've got Kronos brought up here for the next deep dive. And I don't know anything about Kronos, to be completely honest. Let's see here. What is Kronos? I just want to take a look at the executive summary real quick. So it looks like a centralized exchange sidechain. It's become a sophisticated multi-layer decentralized infrastructure. Let me just zoom in here. I just want to read this before we hop into the deep dive. So let's see here. Proof of stake chain, EVM chain, zero knowledge EVM layer 2. Okay. Let's see, what else do we have going on? Kronos app. Isn't this tied to a centralized exchange? Isn't crypto.com? Isn't that the centralized exchange that? Yes, got it. Okay. Yeah. So the CRO token, it had a big pump at one point last bull.
Oh yeah, no, there were some people that made a bunch of freaking money off of the CRO pump.
Yeah. So I mean, I'm taking a look at this, and there's a problem with this chart, though. So the problem with the chart is, see that they call that an all-time high, you know. And if we just throw down a little horizontal right there, the all-time high from 2021, that is 2 bull markets ago, not last bull, the bull before. The all-time high was at 95 cents for CRO. The problem with this chart is that during the last bull, we did not see a fresh all-time high. What we saw was a lower high. And we're also seeing, right now, if I just zoom out a little bit further, last bear market, the lows were put in, around, 4.6 cents or so. And this token is currently trading for, as of right now, what is that, 6 cents? So it's maybe a little bit less than 6 cents, 0.05, so 5.6 cents. So it's trading just off its bear market lows from last bear. It did not put in a fresh all-time high. It's trading just off of its bear market lows from last bear. And if we just throw down, something like this, and then I can remove this, now you've got this big triangle. And you've got the 200-week moving average right here at 9.8 cents. It's trading well below that 200-week moving average. These are all bearish indicators. So, yeah, the chart doesn't tell me anything good. But let's learn a little bit more.
There's a chance.
Maybe. Let's see what's going on with this thing. No. The video content. Let's see.
Let me check on that.
I might need to play it directly from YouTube. Let me see if I can do that or not. Want to see, just hopping on over here into content and videos. I can always play it on my desktop as well. I think we might need to do that, Mike, because it says it's still uploading to YouTube here.
Let's see.
But please spare us the Kronos.
Yeah.
I hear you, Crypto Stevo. So while you're doing that, Mike, I'm going to bring it on over here to DeFi Llama. I want to see what's actually going on Kronos, the chain. Kronos, because I thought that this is becoming like a DApp layer or an app layer chain or something. Let's see here. So $250 million in DeFi TVL, which is down significantly from its DeFi TVL back in April 2022 of $3.2 billion. So let's take a look. 180 million in stablecoin market cap. That's significant. Let's take a look at the protocols. Okay, so whenever I'm reviewing protocols on a chain that I don't operate on daily, like Kronos, I don't operate on Kronos, I want to look for protocols where DeFi Llama says one chain. Let me just zoom in here so we can see this a little bit more clearly. So you see where it says for Tectonic, this is, I'm assuming, a lending protocol like a money market on the Kronos app chain. It says one chain. That tells me that this protocol, Tectonic, is native to the Kronos chain. So that's what I want to look for. I want to take a look at the protocols that are native first.
I'm ready when you are.
Okay, let's just take a look at this. Let's run through the video content. Awesome.
It's on a strict emission schedule to pay its validators. But when a network actually collides with its finite resource limit, that core incentive structure instantly breaks down.
Mike,
this chart shows the total value on the Kronos network.
Yeah.
During the 2022 expansion, liquidity here peaked at $3.2 billion.
Right.
By early 2026, that capital base had contracted and flatlined at roughly $350 billion. But this liquidity drop coincided with a strict mathematical wall. Out of an absolute maximum supply cap of 100 billion CRO tokens, the circulating supply reached 98.54 billion. With only a fraction of the total supply left to mint, the protocol faced a sudden halt in staking rewards. If validators stop receiving emissions to secure the network, they pack up their capital and leave, severely compromising the chain's security. To prevent a total consensus failure, developers abandoned the monolithic chain model. They fragmented Kronos into a modular, 3-layered stack. Surviving this supply ceiling requires permanently turning off the inflation printer. The network must replace artificial emissions with a system sustained entirely by retail-backed transaction fees. Processing high-speed retail payments, complex smart contracts, and zero-knowledge roll-ups on a single ledger creates extreme data bottlenecks. Isolating these tasks into dedicated environments scales throughput. This diagram illustrates the new network topology. The base layer is the proof-of-stake chain. Running on Cosmos SDK, it handles primary validator consensus, NFT registries, and sub-second payment finality using the native CRO asset. The middle execution environment is the EVM chain. Built with Ethermint, it hosts legacy decentralized finance applications by allowing developers to port Solidity contracts directly from Ethereum. Here, CRO acts strictly as a gas asset. This layer also integrates native USDC and Eurocoin alongside Circle's cross-chain transfer protocol. Users route stable liquidity natively without relying on wrapped tokens, removing the security vulnerabilities associated with third-party bridges. The top layer is a high-throughput layer 2, built on...
So, I mean, what do you think so far? I mean, I'm actually hearing some, kind of good things, about, kind of the architecture and, some of the functionality that it offers. It's still a lot more to be divined, but...
Yeah, so the dApps that I use on a daily basis, think, decentralized lending protocols. I used to use decentralized exchanges like Uniswap on a daily basis. These protocols in EVM land, in Ethereum world, they oftentimes will give you the option to operate on the Kronos chain. But that's not where a lot of DeFi TVL lives. And so what I'm seeing here is that this is an app chain built, I believe, by Crypto.com, and it's trying to, I guess, port EVM chain dApps onto their Kronos chain, but hasn't really had a whole lot of success in, driving more user growth on the Kronos chain. And so I'm just thinking to myself, okay, what are the companies, what are the businesses, the protocols that Kronos is competing with for this type of business? They're competing
Zenith.
With Canton and Zenith, right? Yeah. Exactly. So there's a whole lot of businesses, protocols, chains that are competing for the same niche, the same user base.
For market share.
For market share. Will Kronos be the winner here? I don't know.
Oh, we'll see.
On top of Ethereum, using Matter Labs' modular ZK stack framework. Transactions on this zero-knowledge rollup are not paid in standard CRO. Instead, the layer uses a custom gas model denominated in ZK CRO, a liquid-staked, rehypothecated wrapper of the main asset. Splitting the chain successfully isolates functionalities to maximize throughput, but it fractures the user base. This fragmented system demands a highly coordinated economic engine to absorb the supply of these native assets across all 3 layers. By April 2026, only 1.46 billion tokens remained unminted. At the standard 1% emission rate, the consensus reserve would be exhausted by late 2027. The validator set deployed Proposal 33. This algorithmic intervention was engineered to transition the protocol away from an emissions-based staking model entirely. This formula outlines the core mechanic. The first step hard-codes the base inflation rate to exactly 1.00%, disabling the algorithm that previously adjusted emissions based on the network's bonding ratio. Then it applies a decay factor. The monthly inflation is multiplied by a 6.8% monthly decay rate, compounding every 30 days. Plotted over a 5-year timeline, this compounding reduction asymptotically approaches zero. Emissions will practically cease within half a decade. To prevent a mass exodus of validators as this decay accelerates, the proposal implements a strict 3% annual percentage yield base staking floor. If transaction fees drop and cannot cover this 3% yield, a programmatic failsafe activates. The protocol tops up the rewards pool by pulling directly from a 70 billion token strategic reserve, which vests linearly through 2030. Proposal number 33
Mike, can
mathematically
you pause it there for a
guarantees the
second?
total supply will.
So I want to make this point. Over the last couple of weeks, we've seen more and more protocols with broken tokenomics where we see the same thing repeating over and over again, where the narrator, our source material, is always talking about these chains are implementing all sorts of different, upgrades and changes to make it so that their validators don't exit. Like they're running out of the ability to pay their validators to secure these chains. We saw it with Avalanche. We saw it with, we're seeing it with Kronos here. We just saw it with Polkadot, a couple of minutes ago. And so, we've talked about.
Well, and they're struggling with value capture too. A lot of them are trying to, to revamp their tokenomics to, add value capture.
But this is deadly for a chain. This is a death spiral, because if you can't incentivize your validators to keep their nodes running, then your chain dies. So if we've been, talking about a great culling, Altmageddon, where we see so many different competing chains go to zero, where their validators step away and say, look, we are not properly incentivized to secure this network. We need to exit the network. Then that chain dies. So, this.
And to be fair, we're seeing it with Bitcoin. We're seeing where a lot of these big miners, are seeing more value in processing AI data instead of mining Bitcoin.
Right.
And we're not trying to FUD. Like I said, I mean, this isn't fear, uncertainty, and doubt. These are facts.
Right.
It's we need to if you're in these assets, your eyes need to be wide open to the positive and the negative of all these different assets, especially if you hold them. So
look, this is 100% the thing that we need to educate ourselves on, so that we can go in understanding what it is that we're buying and holding. But we've talked about a potential Altmageddon in the past, where maybe a lot of these chains and coins and projects just cease to exist. And if we are solidly in the blockchain wars right now, just like the operating system wars and the browser wars that we've seen in the past, well, then we should see winner take most, where you've got all of these chains competing for the same user base, and liquidity goes where it's treated best. So it looks like this validator set fleeing because they're not incentivized. This is the mechanism by which a lot of these chains cease to exist and go to zero.
Never breach 100 billion. However, it places the network on a strict timer. It must generate vast real-world revenues to pay validators before the strategic reserve is fully diluted.
To replace the decaying token emissions, the ecosystem relies on its centralized core, the Kronos app. This platform acts as an onboarding funnel. Users push fiat directly into on-chain instruments without managing seed phrases or bridging transactions.
It's like a sewer.
By offering spot crypto trading, tokenized real-world equities, and margin leverage, the app generates massive programmatic revenues. This includes commission spreads, asset liquidation penalties, and margin loan interest. This flowchart tracks the
and that's something that you could consider bullish. I mean, it does have a centralized exchange behind it that helps it generate fees. So if crypto.com ends up growing and becoming very successful, then potentially that could generate fees that help out the token.
So here, let's pause for a second. Are you betting on crypto.com when you swap into CRO? It seems like this value capture cycle that we're about to learn about, if crypto.com does not suddenly become like the number one exchange in the world, where there is a ton of volume, then the CRO chain might be kind of SOL.
Yeah.
Value capture cycle. Fiat and stablecoin revenues generated by the app automatically convert into on-chain market buys for CRO. Simultaneously, a programmatic deflationary mechanism destroys 15% of all transaction fees collected across the EV.
Only 15%.
Right. Yeah.
As opposed to hype,
100%.
Yeah. And same thing with Canton, with the fees that it generates,
Right.
100%.
Yen and POS chains. The capital acquired through the app is then funneled into the rewards pool, directly financing the base consensus yields and liquidity mining incentives. This engine creates a closed loop. It aims to migrate the network from an economy dependent on printing tokens to one sustained by actual retail trading volume. While this revenue cycle scales, the protocol must restrict the existing circulating supply to maintain baseline price stability. It achieves this through a tiered time-locked staking architecture, explicitly incentivizing long-term capital commitment.
Yeah, it has
and
not.
I would be real careful, and I'm kind of what's the word I'm looking for? Not a friggin' basically, because I have arrow locks. These time locked staking and stuff like that. Usually not a huge fan of them. I have my reasons why I did my arrow locks. You do your own research if it's something that you're bullish on. Arrow long term, but not a huge fan of any kind of staking that has a time lock on it.
Me neither.
Delegators execute the MSG commit delegation to tier transaction to secure a bonus yield on top of the base consensus rate. Users lock their positions for 1, 2, or 4 years, temporarily removing that liquidity from the secondary market. To supplement retail volume, the parent company utilizes external corporate funnels to capture highly regulated institutional capital. In early 2026, the U.S. Office of the Comptroller of the Currency granted conditional approval to operate as a U.S. national trust bank, allowing the parent entity to custody assets for institutional spot products. By May, the company secured a stored value facilities license from the Central Bank of the UAE. This authorized the firm to power government fee settlements using the Kronos network directly. The network relies heavily on these strict capital locks and massive institutional partnerships to anchor its valuation, while the decentralized applications attempt to build organic traction. The technical structure presents a paradox. While the POS layer utilizes a decentralized Cosmos SDK architecture, the execution environments operate under strict centralized control. Consensus on the EVM chain is secured by a proof of authority validator set. Participant identities act as stake, vetted and managed by the parent company. This dashboard tracks the network's systemic risks, beginning with governance. When the protocol required 70 billion burn tokens to be reissued into the strategic reserve, 87% of retail delegators voted against it. Institutional voting weight simply steamrolled the community. Wallet concentration presents a secondary vulnerability. Just 10 individual addresses control roughly 8% of the entire mainnet supply. Capital on the protocol layer is equally dense. The vast majority of the chain's total liquidity is locked in just 2 protocols, VVS Finance and Tectonic. Any security exploit on these anchor platforms would devastate the network's financial profile. But the ultimate vulnerability is execution. If the retail app fails to generate the massive revenues required to match the compounding decay of emissions, the system enters a negative feedback loop. Without real trading volume to fund the rewards pool, staking yields compress. The protocol is forced to aggressively dilute the strategic reserve to pay validators, maintaining extreme structural sell pressure on the secondary market. The 2026 Kronos ecosystem demonstrates complex, modular tokenomic engineering. Yet its survival depends almost exclusively on the centralized corporate success of its retail applications, proving that architectural upgrades alone cannot fix an empty ledger. Every blockchain.
Yeah,
that's so true. Oh man, so we just watched 2 videos that are both of them case studies on what death spirals look like in crypto.
Yeah.
So if you can't pay your validator set, then you don't have a product. It goes away. So yeah, not good. Oh man.
And Steve-O, it's we're doing deep dives on all projects, good, bad. We're just going through, we're just going down, the top 100. And because how it works, as soon as crypto starts picking up, something gets a decent pump, then, people are it's going to start getting mind share, and people are going to start freaking FOMOing and, aping into these, different projects if their token is shit or if it's good. And so we're trying to build out this library, over here on our website, our Intel library. We're building this out. And, anytime I'm talking to somebody on X about a project, I let them know. I'm like, listen, I'm not saying that, all of these are 100% accurate, but it's going to give you a very good picture, a very good start on understanding, these different assets at a deep level. And you can use these to as a launching pad to dive deeper into it. Because if you watch these, then you're gonna have an understanding if the token has value capture, if it doesn't, things like that. And for me, that's the only stuff I'm investing in. If you
so
go
Mike,
over,
what type of grade would you assign to Kronos? And then we can talk about Polkadot. What grade would you assign it?
I would say, I hate to say it, but I would say probably a C, just because that it does have, crypto.com, and it does have some retail things that potentially could, be beneficial to the token. I usually only give Ds where there's no value capture. It does have it's poor, but it does have value capture.
Okay, so, as you were speaking, I was thinking to myself, what is crypto.com's market share? Like, they're competing against a lot of, I think, much larger exchanges, right?
Oh, absolutely.
So it looks like, Binance continues to dominate when it comes to global spot trading volume. And crypto.com, so if we compare, so Binance median daily trading volume on Binance, $18 billion a day. Coinbase, just in spot, says, $1.3 billion a day. I need to verify that. I don't know if these data are accurate coming out of Gemini. But it says crypto.com, $2.8 billion in median daily trading volume. That's not nothing. So, but what we just learned about it's,
if it's earning that, and we're still seeing the token, do what it's doing, that doesn't say a whole lot for the tokenomics.
Because
if that's supposed to be fueling, like a deflationary aspect, or programmatic buyback and burns. And
what did we see? 15%? 15%?
It's only like 15% is used for buybacks and burns.
It's not enough.
If that was 100%, like Hype, or like Canton, or these other ones that have much better value capture, the CRO token might be one of those that is moving to the upside while the rest of the market was dumping. But I don't think
so. I guess 15 is not. Obviously, because we see the token just do nothing but go down. Yeah. So I guess if you swap into CRO, what you are essentially saying is that you're betting on Kronos, or you're betting on crypto.com, really. You're betting on crypto.com. Okay, well, hopefully crypto.com becomes, one of the top 3 exchanges then. That's essentially what you're betting on. So if you want to give it a C, okay, I can give it a C. What do you think about Polkadot?
C minus, D plus, maybe. If we can.
Yeah. I need to add in like the pluses and minuses. Yeah. What do you think about Polkadot then? That'll be the last one.
Polkadot, D.
Yeah, definitely give it a D. And I'm going to call it, like, it's not even a layer 1 base layer. Like, what is it? It's like a cross-chain bridge layer. So I'm going to give it a D. And I'm going to update that in the back end here in the admin. So there we go. Gave Polkadot a node grade of D, and gave CRO, Kronos, a node grade of C minus, given that, hey, it's still got that crypto.com exchange behind it. So yeah, tokenomics for both of these do not look good.
No. All right. Well, if you want to support the channel, the most powerful thing that you can do is just give us a like, give us a subscribe, help share out the stream. We're trying to give, good, solid information and education here. If you see this and you feel like we got something wrong about either of these projects, please reach out to us on X, reach out to us in our Discord, and let us know. what it is that you feel that we got wrong. And if you can cite the source that shows that we got it wrong, we're more than happy to update, our information and update the grade. But keep in mind that we are grading it off of our trifecta, which is, the value capture, the fees and revenue generated, and adoption. That's what we grade these off of. So if you want to learn about DeFi and learn about crypto, no matter where you are in your journey, if you're a beginner, intermediate, or advanced, you can come here to our Leering Center, and you can learn about, you can start our structured courses. And this is 100% free. We don't charge for any of this. David built this out himself and has graciously offered it to our community for free. This is something that other channels charge hundreds, thousands. I've seen some charge tens of thousands of dollars for these education.
Me too. And we give this away.
And we give it away for free. So, again, structured courses with quizzes and tests and, all of that stuff.
I turn these into books too, Mike. These are also books that are available.
Yep. Another free thing that we give away is the Intel library. So all of these deep dives that we do, 13 a week, is what we've been doing. And it's, we go through and we give you the nitty gritty on all of the nitty gritty of all of the different projects, that you might be interested in. And we do stocks as well. We did it on SanDisk, we did it on Micron, but we just go through and just look at all these different projects and what they are currently, not what they could become, but what they are currently. So go ahead and take a look at that. Again, value that we give away here at the Node. The AI newsletter. This is not dialed in yet, but right now you can use it at no cost until we get it dialed in. So if you want to come here and want to generate the newsletter to where you can find links to news articles, it goes through and it scrubs the internet for you. It'll save you an hour or two in your morning, and it will give you an idea of what's going on in the market and kind of educate you on what's going on in the markets. Our community, again, no charge. Other channels charge for their Discord. We don't charge. Hop in the Discord, chat with the community, ask us questions, let us know that we're assholes because we butted your project, whatever. And if you want to sign up for one of our
facts are not fun, brother.
No, they're not. If you want to join our 3 hour long calls, Monday, Wednesdays, and Fridays. Live with David and other members of our community, live video calls. You can start your free trial and you can do it for a week and see if you find value in it. Even stuff that we charge for, we give you free trials. And if you find value for $98 a month, you can join and join those 3 times a week, Monday, Wednesday, and Friday. You can join those calls. I didn't share that. So yeah, that's what it looks like if you click through on this live get premium live calls. And then our programming. So me, Jeff, and David go live multiple times a day. So today is Wednesday, finishing up this show right now, here in about a minute or two. Jeff at the Blockchain Report. He's our expert on very early projects, some of which haven't even had a token generation event. So if you're looking for that low cap gem, he does deep dives like we do here, but on those low caps, if you want to check him out. Also, David, Monday through Friday, does a daily market recap and TA. So he does a bunch of technical analysis on crypto and on TradFi. That is 4 p.m. Eastern, 1 p.m. Pacific. Later on today will be that paid live call, or if you get that free trial, you can try it out. And tonight I will be doing gaming and chill. So I'll probably end up playing the tank game. It's just easy. So I'll be playing the tank game tonight. World of Tanks. But you can see, we have then tomorrow we got the red pill. That's where we get political and stuff. But yeah, if you want to check any of that out. Oh, hey, David's dad. Haven't seen you in a minute.
Hi, Dad.
Oh, what up, Mrs. Emmy? All right. So, oh yeah. Now we need a hoodie that says "Facts Not FUD" or a hat.
I like that. That's a good idea.
That's actually a really good idea. Or facts aren't FUD.
Facts are not FUD.
I like that. I like that. I need that on a hat or something. All right. Well, we appreciate y'all for stopping by, and hope that this brought value. If you could, again, please, if it's free, go to the bottom, hit the thumbs up, like, subscribe, share. It helps us get the word out and helps educate people with good, solid information that isn't hyped, that isn't paid for. That is the key. So with that, thanks again. And until next time, Veteran Crypto out.
Peace.